theory, dynamic contracting, and growth theory. She has been a research associate at the National Bureau of Economic Research since 2013 and a consultant at the Federal Reserve Bank of Chicago since 2014. Randy Kroszner is Deputy Dean for Executive Programs and the Norman Bobbins Professor of Economics at Chicago Booth. Randy served as a governor of the Federal Reserve System from 2006 until 2009. He chaired the Committee on Supervision and Regulation of Banking Institutions and the Committee on Consumer and Community Affairs. Randy took a leading role in developing responses to the financial crisis and undertaking initiatives to improve consumer protection and disclosure. Our third panelist is Brent Neiman, who's the Edward Eagle Brown Professor of Economics and the William Ladany Faculty Scholar at Chicago Booth. Brent served as the staff economist for international finance on the White House Council of Economic Advisors. He conducts research on international macroeconomics and trade and serves as the director of the Initiative on International Economics at the Becker-Friedman Institute. We're thrilled here today to have Henry Kerr as the moderator. Henry is economics editor of The Economist, where he's the principal leader writer on economics and oversees economic coverage throughout the newspaper. My thanks to Henry for moderating the event. And with that, I'll let Henry take it away. Thank you.
Thank you very much for that introduction, Madhav. I'm delighted to be moderating this panel at this extraordinary time for the global economy. Before we get going, I've got a bit of housekeeping to do. So we're going to have 4 people speaking on the call today, but we're hoping that it will be an interactive session. So if you want to ask a question, please type it into the Q&A box and we'll have questions from the audience as we go through the session put to the panelists. If you have any issues with the audio, you can always dial in by telephone. We have an hour here before we wrap up. And finally, this session is being recorded and will be made available on the Chicago Booth webpage afterwards. And with that, let's get started. So where I'd like to begin is on a subject that is in the news around the world at the moment, which is monetary policy. We were just saying before the call that Jay Powell is speaking at 2 p.m. in America. He kindly scheduled his remarks not to clash with this session. But here in Europe, monetary policy has been in the news because of the controversy regarding the ECB decision and the ruling by the German Constitutional Court regarding that. So I thought, Randy, perhaps we could start with you for your thoughts on monetary policy in the current environment. As a former monetary policymaker yourself, of course, what do you see as the role for monetary policy in this crisis, and how is Europe faring?
Thank you very much for that, because I think that's a very, very important issue, and I think people are focusing a lot on what central banks are doing, and I think central banks have done a lot, and there's probably more that they can do and undoubtedly will do. The challenge is that we've got this shock, which is very different than the kind of shock that happened when I was at the Fed a decade ago, when really the origin of the problems were in the financial system itself. Here, the shock obviously is from outside of that. It's the virus, and then the policy responses that have led to an effective shutdown of production and of consumption. So central banks have responded by trying to provide liquidity to the system, reduce interest rates, and I think do that proactively. And I think that's been extremely important to provide a proper functioning for the markets. But I think one of the challenges is that many market participants and people think that somehow the central banks can cure the virus. And there's no way they can do that. Central banks can't repair broken supply chains. Central banks can't get people to consume if they're locked down at home and they are scared about going out. Central banks can't get people back to the office and work. They can try to provide incentives. They can try to provide low-cost sources of funding for companies to sort of soften the blow, but they themselves can't do that. And this is going to be a particular challenge here in Europe because of that German High Court decision, basically challenging the ECB's authority to undertake asset purchases, which is a very important part of what they've done before and what they're doing now. My understanding is what the court said is, well, they need to do a proportionality analysis, which basically says, my understanding is that says that they have to explain how this might affect every possible asset class, how it might affect employment, unemployment, whether there are unintended consequences. Now that's a wonderful and important academic exercise, but this is current policy where central banks have to be responding. This is also a fundamental challenge to the independence of the ECB. It's a bit ironic that the Germans were so insistent on, I think, and I would agree, that to make the ECB independent. But now if each country's court could say, well, we don't really like what they're doing, they have to, we don't have explanation, they can't do this, that's a problem. And that's gonna raise questions about how active the ECB can be in responding to challenges. And those challenges are only gonna be getting greater. I don't think they're gonna be getting less.
Of course, the appropriate monetary policy response in this environment depends, as you say, on the nature of the shock. We've had a demand shock, we've had a supply shock as well. One of the questions we've had from the audience is whether we're facing more of a demand or a supply shock at the moment, which has been destroyed more. Veronica, I think that might be one for you.
Yes, thank you. So my way of thinking about the shock is that for sure it's at first a shock that hits the supply side of the economy in a more direct way, because first people are scared about going to consume. So even before the lockdown, people were not going to restaurants, were not going on vacation just because they were scared of the spreading of the virus. Then with the lockdown and a policy that has been implemented, of course, this has been becoming even more extreme. So complete sectors have shut down and production disappears. So clearly this is a supply shock. But the question is not what is the origin of the shock or how the shock manifests itself in its first place, but what are the main, in which way the shock propagate to the economy. And the question is, are there demand effects coming from the supply type of shock that can dominate the supply nature of the shock itself? And this is important for monetary policy and for fiscal policy, because if the shock was fundamentally supply shock, standard supply shock, then probably it would not be necessary to stimulate the economy. But what I show in some work that I've recently done is that actually it may be that the way in which the shock propagates to demand is going to be even stronger. So the demand side effect is going to be even stronger than the original supply shock. And so the demand shortages that is going to spread out to the sectors that have not locked down yet or that are still alive is going to be stronger. And this is because some goods that are produced in other sectors may be substitute, but some may be complements. And so people may decide, like, if there is no possibility to go on vacation anymore, I'm not going to buy new cars. And also because there are incomplete markets, so people lose their income. Workers in sectors that are shut down lose their income, and if there are financial constraints to their availability to access some lending, then they're going to stop consuming. So once the shock becomes stronger on the demand side, definitely we need some more expansionary, aggressive monetary policy and fiscal policy. And another way of looking at that is that what does it tell us in terms of expectation about inflation for the monetary authority? Well, our prediction is that if the demand side of the shock is stronger, well, we should expect deflation. And we have seen recently that the CPI has actually been going down. So it kind of confirmed, I mean, the data are preliminary, but that there is no inflationary pressure coming from the shock. That is something that one would expect if the shock was mainly on the aggregate supply side. Now, it's true that there are some caveats that one has to make, because when some goods completely shut down, we don't have the price for those goods. So possibly the price for going to a restaurant without getting infected now would be infinity. Everybody would love to do that. But actually, this is exactly the nature of the shock, because when we think about the demand effect, we want to focus on the sectors that are still open. So where is that people could consume? Are they consuming more or less? And so in a sense, exactly the fact that the price of those goods are going to go to infinity would make people actually it's exactly the nature of the fact that we are focusing on those sectors. And so even though there would be a spike in inflation for those sectors, those are not available. And so we have to focus on where the demand can be stimulated.
If anyone on the call is interested, I'd highly recommend Veronica's paper on this. It's fascinating and very lucidly shows how a supply shock can morph into a demand shock through these sectoral linkages. Veronica, I'd just like to linger on this inflation point for a while, because although it's fairly clear when you look at financial markets that the impact has been disinflationary, that's how policymakers are treating it for now. As you say, the data's not so good at the moment. And you do have this vocal minority of people who say, once economies start opening up, you're going to have all this extraordinary economic stimulus run up against a still constrained economy. So I guess my question is, how confident are you in that breakdown, or is it just a sort of central scenario with a lot of uncertainty?
So, I mean, of course, there is uncertainty and I cannot make this disappear. But my view is that even when the reopening is going to happen, we're going to go to phase 2, phase 3, phase 4, and maybe and hopefully consumption is going to be stimulated. It's true, inflation will start going up again, but it's the shock that is disappearing, so it cannot spikes above the original value. It's just going to go back slowly to where we were. And the only concern about longer term inflation, I don't think it comes from the fact that we're going to reopen and this is going to stimulate demand. That's actually good, and that's actually something that we want to see. I think the broader concern about future inflation is coming from the fact that a side effect of this very aggressive fiscal policies that governments are going to put in place may generate level of debts. Both public debt and also private debt is going up, and this public debt in the future may create a concern and may generate monetary action that can generate monetization of debt, and so possibly having upward pressure on inflation. This is what I would be more concerned thinking about inflation, but this is more down the road. It's not about the shock disappearing and the reopening.
Another thing we should consider when we're thinking about the nature of how economies are working at the moment is the unique circumstances of labor markets. We're all we are working from home. Large numbers of people are unable to work at all right now. Extraordinary policy support in place for labor markets. Brent, how do you think about how labor markets are performing right now, and what determines their success or lack of success?
Well, it's hard to get a good snapshot in real time of exactly how labor markets all around the world are working now. As a start in research together with a Booth colleague, Jonathan Dingle, we tried to think about what might be driving that initial supply shock that sort of got things going in the work, for instance, that Veronica was just talking. And the way we tried to do that was estimate before the crisis started, how many jobs could potentially have been done entirely from home? It was a question that kept coming up in conversations among colleagues and with policymakers on what the future might hold looking ahead at the COVID crisis. And I don't think we had a very good answer. So Jonathan and I classified jobs using this survey called, surveys administered by a group called the ONET in the United States, which is sort of funded and works in collaboration with the Department of Labor. And it tells a little bit of, it gives details on what characterize various occupations, almost 1,000 different occupations. It tells you whether those occupations involve running, operating heavy machinery, things like that. And so based on those survey responses, we characterized what percentage of jobs by country, by industry, by city in the United States could be done entirely from home. And there's sort of three things that I think we took from that I think are important to think about as this crisis unfolds. First is just to get a sense of the scale of things. We found that 37% of all US jobs could be done from home. Going into the project, we weren't sure if it would be a majority, if it would be a very, very small minority. The way to think of it is, almost 40% can be done from home, but that means that most, about 60%, can't be done from home. So that's the first thing to think about. Necessarily, a lot of labor output, a lot of labor production could not happen when the country was restricting people's access to their workplaces. That might have been the right thing to do. I was generally supportive of the view that the public health crisis should be taken into account first and foremost. But it is important to think about how deeply this affected production of labor, and that gives you a scale. The second thing it told us is that there's a huge uncertain inequality, a big difference in who is impacted by this shock. So even though 37% of jobs can be done from home, they actually account for 46% of all US wages. And underlying that, you can see very clearly the pattern in our data that higher wage professions are more likely to be able to be done from home. Think of finance, insurance. Lower wage professions typically can't. And so whether that means that the jobs that are most at risk are those of lower wage earners, who presumably have less of a buffer stock of saving and less capability to handle a period without income, or whether it means that in fact it's lower wage workers that are going to be the ones that have to face risks by going out and continuing their job out exposed in the public. It gave an initial flavor of how unequally, how unevenly the burden of this crisis, at least so far, appears to be, hitting society. And lastly, sort of an extension of that inequality point, we look across countries, and there you find sort of a striking pattern where the richest country in our data set is Luxembourg. That's the one country in our data set where most jobs can be done from home. A lot of the poorer countries, very, very few jobs can be done from home. It's quite intuitive. In part, you can imagine that a lot of those countries don't even have the broadband infrastructure to facilitate working from home. And the relationship was very strong, where intermediate countries had an intermediate ability to have their jobs performed from home. A country like Mexico had closer to 20%, 22%, I believe, of its jobs that could be done from home. And so, the last thing we took from that initial work was that thinking about what this crisis will look like internationally, you might see, very big disparities in the ability to continue production, with workers at home. And unfortunately, it's going to be most difficult for the poorest of nations.
It strikes me that puts policymakers in a really difficult position. A lot of them across the rich world have put in place these extraordinary support schemes. And a lot of countries are now asking, how can we unwind those schemes, which are essentially, certainly in Britain and in large parts of Europe, are essentially paying workers who have been furloughed, who are not currently working. And so as you think about how you reopen your economy, you've got to have a scheme for getting those people back to work. But as you say, lots of jobs cannot be done from home, and the conditions in the workplace may not be safe. So long as you're enforcing lockdowns or anything like it in any sector, you have to provide support for the workers. So it seems to me that there's something of a trade-off there for policymakers. Randy, I'd be really interested to know what your take on that would be, on how we should design labour market support programs, or indeed amend the ones that are in place already.
Sure. So I think a lot of the policies, whether it's the central bank policies, but in particular the fiscal policies, have been around trying to preserve jobs and preserve jobs at particular organizations. So a lot of the schemes, like the schemes in the UK and in continental Europe, as well as in the US, a lot of it has been providing either grants or very low-cost loans, or loans that can turn into grants if small, medium-sized, as well as large enterprise don't fire their workers if they bring the workers back. The challenge is that I think this shock is a really fundamental shock to the way consumption will occur and production will occur going forward. I was at the Fed during the global financial crisis, and I was also working in the White House when 9/11 happened. When 9/11 happened, obviously we closed down the air transportation system. A lot of people were very concerned about traveling, but when it was reopened, we said we believe the system is safe and you can travel on it. And that if you want to be patriotic, go back out to the shopping malls. Don't change your lifestyle. The message here has been dramatically different, and I think people have taken that on board and are going to continue to operate that way, even as things slowly unlock. And so I think what that means is that we have to pivot policy away from preserving the past to try to facilitate a move to the future. Basically, I think of it as the meteor has struck the US. The dinosaurs are going to become extinct, and no amount of policy can sort of bring those dinosaurs back or make them keep them alive. We have to accept that things are going to have to move forward. Now, that doesn't mean that you don't provide support for workers, but it's a different approach. Rather than trying to preserve the job in the organization that they were in, you try to provide the support to the worker. And so, for example, I think we need to move in that direction, because we won't be able to just go back to the way things were in February or March. And we can do that through providing support to individuals. For example, in the way some schemes work, you have to go to the unemployment office each week or each month to say you've been looking for a job, and then you get your resources and get those just locally. That doesn't make sense when you want to allow people to be able to move or be able to retrain. And so maybe what you should do is have something that I had proposed during, and we had proposed in the Council of Economic Advisors back during in 9/11, a personal reemployment account. So you give, you look at the expected amount that you're going to be paying to an unemployed worker over, let's say, a 2 or 3 month period. Give that money up front in an account, and don't make that tied to staying somewhere locally. If the jobs are in Luxembourg, or if the jobs are elsewhere, or if the jobs, or if someone needs to retrain, if someone needs to pay for childcare, use those resources for that to allow the person to make the transition. And I think that's something that's I think a much better way to use resources to try to provide support to the individual workers and their families, as well as to get the incentives right for them to be able to move on, rather than try to preserve a world that just can't be preserved. The dinosaurs will be extinct, and there's no amount of resources that'll be able to bring them back.
We've had an interesting question from the audience here saying, can you compare and contrast the differences in labour market mobility in the US and Europe, and whether those differences may impact the speed of the recovery? If what you say is true, and there needs to be some labour market reallocation going on here, do you think that puts Europe in a worse position than America?
I think greater labor mobility is a very much a plus, and I think you can see in the response in the recovery from the global financial crisis, a faster recovery in the U.S. There are a lot of different reasons for that, but in part that is part of it. It's also interesting if you think about these personal reemployment accounts. If those are all being given by the local, the national government, or the local, or given locally, then it's harder for people to move across state lines or country lines. In the US, if you break down some of these barriers, it's easier for them to move across state lines. And of course, some of our states are very big. So I think thinking about the situation you're in, thinking about Europe in particular, and thinking about, well, is there something that would be European-wide to allow for easier reallocation? That's something that I think will be helpful in the intermediate to longer run for recovery.
Can I say a word on that discussion? So, I mean, I totally agree with Randy that the current epidemic may represent a moment of technological progress that is going to generate a restructuring in the economy, even in a positive sense for the future. However, I mean, I can see also an argument in favor of helping workers attached to their jobs. And this is more, for some sectors, of course, more than others, sectors that we believe are going to be less affected by this restructuring. I think there is an important consideration that is, it is hard to find a good match for a firm worker. And there is a lot of training on the job and human capital accumulation that would be lost if workers are just left outside the job, and then the firm, when things reopen, has to go through the whole process of refinding the right workers and retraining them and providing them with the right human capital. So of course there is a trade-off here. So I see arguments in favor also of helping workers to stay attached to their job. Although I see the problem that this can constitute a drag to a natural restructuring of the economy, that it may be positive for the future. So in that sense, though, I'm a little bit less negative on Europe, because for the short run, these instrument of helping sectors to reopen when they have their workers already in place is going to help them recovering faster. And Europe, traditionally as a more sclerotic labor market, has a bunch of these kind of instruments already in place. For example, Italy has Cassa Integrazione, which is well designed. I mean, as its negative effects, but in terms, if the objective is to keep the workers in firms that have trouble temporarily, it is well designed. While we know that it's hard to design policy like that, as we have seen for the payroll protection program in the US, because the risk is that you try to help firms to retain their workers, and then you end up helping firms that would have retained their workers anyway, and they actually didn't need the help. So in that sense, I think that maybe Europe, that has institutions like that, can have some advantage in the short run. Now, in the long run, I agree, then this is gonna, it depends on how strong this restructuring is gonna be. And I think the right thing probably would be to think more carefully which sectors we're talking about. And for some jobs, some types of jobs, some sectors, it may be helpful to have programs like that in place. For others, instead, it's better to leave the economy going in this direction.
Let me just jump in with a couple of quick thoughts on this topic. But one is, I mean, I think the sectoral dimension, the heterogeneity across sectors really is huge, in the sense of, for instance, if you look at the restaurant sector in the US and you ask, what's the typical duration of a job match between, a waiter, for example, and a restaurant, or some of the hotel jobs in travel and entertainment industries, it's actually very, very short. So short that it's hard to believe that there's tremendous sort of match-specific capital that's critical to preserve. On the other hand, in manufacturing, other industries, it's quite easy to imagine that's really important. So differences in importance of those kinds of sectors and their composition across countries, I think will probably manifest in how much is lost when these matches are inevitably broken. And the second thing to quickly note is, I agree with Randy that given the scale of this shock and how it implies different technologies likely to be important to employ going forward, there's been a lot of very natural talk about firms trying to produce in a more capital intensive way, substituting towards capital away from labor, for example. But I do think, at least in the short run, there's a couple of important impediments to that. One is usually that requires a large capital outlay. To the extent that's the kind of structural change and transformation we're talking about, it's hard at a time when a lot of firms are constrained. Second of all, a lot of times the actual guts behind that is installation of imported capital machinery and capital goods, a lot of which, for example, is made in parts of the world where the supply chain is already muddied, for lack of a better word. And so, I do think that you have a bit of a tug of war between a lot of these forces. On the one hand, the incentive to change the way in which production occurs surely is quite high. On the other hand, the mechanism to bring about that change is certainly going to be dampened by some of these real world constraints that, at least in the short run, can be quite powerful.
We're getting a lot of...
Oh, sorry. And unfortunately, that's why it makes me pessimistic I'm usually pretty optimistic, but it makes me pessimistic in the short-term intermediate run, because I think, and we just saw like a report today in Europe about how investment has just cratered. I think you're exactly right. We're not going to be seeing a lot of investment, but I think you need that investment in order to come back. We're not seeing it. I mean, I think the central banks are trying to provide as much support as possible for that to occur. But given the uncertainties, given the difficulties of making that transition, I think we're just kind of freezing for now. And that's going to make the short run negative impact, I think, even more intense. And also, I think we'll take a very big hit to productivity. Sorry, Henry.
No problem at all. I was going to say that we're getting a lot of questions about another type of structural change that might come out of this crisis, which with regard to trade and supply chains, which Brent mentioned briefly there. Whether lots of manufacturing is going to be reshored as part of the structural change after the crisis, what the implications will be for multinationals, and what the implications will be for the trade war. Brent, I know this is a subject that interests you. I wondered if you could talk a little bit more about those issues.
Yeah, so, we had a trade collapse in the previous global financial crisis from 2008 to 2009. And what we saw then was again, relative to total economic activity, a cratering of trade, driven largely by the decline in demand for durable goods, for investment goods, which was sort of natural as part of that recession. And durable goods and investment goods are the most heavily traded goods. And so typically in a recession where there's a freezing of spending on investment, you would expect to see a collapse in the value of trade. And I think certainly we're seeing some of that now. There's additional and perhaps longer term shocks, though, that are coming along that are accompanying the COVID crisis when it comes to international trade. One is that we're actually seeing in many dimensions an increase in the cost of doing trade. So oil prices have come down. On the other hand, some good shipments occur, in the underbelly of, along with passenger travel. And certainly we're seeing substantially less even passenger travel around the world. And that's likely to continue, I would imagine, for a while. Furthermore, some softer things that we know lead to trade relationships, being able to go to a foreign supplier and decide to source from them, decide to have longer term relationships, which lead to import-export ties. It seems plausible that we're entering into a world in which these relationships are harder to form. The final thing, which is actually a major difference, is that the protectionist sentiment that we saw on the rise over the last 5 years, let's say, in fact, predates the COVID crisis, and we did not enter the 2008-2009 trade collapse and global financial crisis with a similar environment. Here we had the US trade war with China, which started several years earlier. Now that some countries like the United States have seen their domestic supply of medical goods, potentially inadequate, countries have put on export restrictions. The US has talked about export restrictions. And so I think the prospects of entering a world in which these sort of barriers to trade exacerbate what would already be a very negative shock to international trade and supply chains, coupled with the fact that things that are complementary to doing international trade, like traveling, is likely to remain subdued for quite some time. I think there really is a scenario where trade stays even in the medium term, even after we've gotten past this initial public health crisis and the economy stabilizes. I think there's a scenario where we see a lot less trade.
Veronica, do you think the trade channel of propagation for this crisis is important? Is that something you think about when characterizing the nature of what the economy is going through right now?
Yes, absolutely. So I've talked about the effect of demand of the supply shock, and this is clearly, and trade is very important in that. In more general, supply chains are important for that. So we have talked a lot about China at the beginning of the COVID-19 pandemic. When it started in China, we were talking a lot about, well, we're going to see a reduction in the supply of intermediate goods for the US industry. This is going to be a negative shock for the US. But there is another direction of the supply chain that is important now that the pandemic has been spreading all over, which is sectors that are closing up, where demanding goods from other sectors that may be still open. And so this is actually a big and large amplifying factor of this demand effects for these sectors that is important to consider. And this is true within a country, like all the country. This is true if you consider countries, they trade across countries. So there are countries that are going to be hit, that have been hit by the epidemics earlier than others. There are differences in the lockdown policies that government have been put in place, and this, of course, has effect, important effect for the trade of intermediate goods that are going to affect industries, entire industries in countries. And so, the natural policy recommendation that comes out from these considerations within a country and across country is that an optimal fiscal policy will require insurance. So now this is a little easier within a country, insure workers across sectors, as we have talked about different type of policies in the labor market to help workers in one way or the other, attached to the job or not attached to the job, but workers that have been particularly hit because their sector has been locked down. So these type of policies are easier within a country. They're more difficult when we start thinking across countries. For example, let's talk about Europe for a second. In Europe, there is something that could go in that direction because there is clearly a high level of trade across European countries, and there is a European Union that could create some steps in this direction with the help of the ECB. Naturally, we have seen that this has been proven hard previously with the sovereign debt crisis, and now there are clearly tensions coming out from that. But the natural way of thinking about that is that insurance now is particularly important. So I see that as an important step, that another important challenge that Europe is facing, and what is going to come out from that. I think that either Europe is going to strengthen the fiscal component of their union, or there could be another backlash, another crisis of the European system because of these linkages across countries due to trade. And then, I hope that the first thing is what is going to happen, but there is uncertainty around that.
And actually, sorry, go ahead, Henry.
I know, I was just going to say, one of the questions we had from the audience was, will the eurozone survive this crisis? So I was going to ask if you, Brent, or Randy had views on that. That may not have been the question you wanted to answer.
No. Randy, you want to kick it off, or
Brent, you go.
No, I have no. I'm unwilling to make a prediction on whether the eurozone will survive or not. What I will say is one interesting thing we've seen over the last 10 years in essentially the run up to the crisis is that the dollar relative to the euro has increased its use as an international currency. So what do I mean by use as an international currency? There's a variety of things that you look for in understanding whether a currency is providing such a benefit to a country. Is it used in international shipments to invoice imports and exports? Is it used to denominate bonds that are invested in across international borders? Is it used as a share of reserves by central banks? And in the 10 years or so from the financial crisis on, the euro actually had been used less and less in those sorts of roles relative to the US dollar. Why is something that remains, I think, a bit uncertain at this point. It is possible that the world's investors, thinking to themselves, what's the safe assets in the world, entered the 2008 crisis unsure whether it was the US dollar or the euro. And if you look at the stability and actual appreciation strengthening that occurred in the US dollar during that crisis, perhaps the proof was in the pudding and the data gave an answer that it was the dollar that in fact delivered as that safe asset. And so this is also kind of puzzling but interesting because it also occurred despite the fact that many would argue the US was the center and sort of the spark of the 2008-2009 crisis. And current dollar performance, is despite the fact that the COVID crisis is particularly bad right now in the US. So at least in thinking about the euro going forward, it does look like that comparison to the dollar's performance is important. And in many of the roles that surely, the euro's creators would have wanted the euro to fulfill, coming into the crisis, the euro was not in a position of particular strength.
And there continue to be these sort of existential questions about the euro, both before, when Mario Draghi made his famous statement, "He'll do whatever it takes, and believe you me, it'll be enough to preserve the euro." And obviously, during his tenure, has been able to do that. But just having to say that raised questions in people's mind about whether it would survive. You now have another potential existential threat with the German court decision on, will you have an independent central bank? Can the different countries just raise questions both about what the central bank is doing and perhaps others? There's this bigger question about the European Court of Justice versus the national courts, how you resolve disputes there. And so we had in Europe a European Union on the monetary side, not on the fiscal side. There was a potential here that this could be used as something where you'd have not only the monetary union, but maybe take steps towards closer fiscal union. But it's possible it is going the other direction. And I think that raises questions. And I think that's why you don't see people running to Europe, the euro, but still people going to the US dollar.
I mean, uncertainty, Henry, plays a large role in all of these questions. One thing I think it's sort of novel for economists, we've been talking for the last decade a lot about policy, economic policy uncertainty. Here, a very large share of the uncertainty underlying a lot of these phenomenon is to do with the actual disease itself. We were earlier talking about trade, and I should have mentioned then that in fact, one of the key things that can inhibit a return to current or pre-COVID levels of trade would be the elimination of uncertainty about whether it's worth setting up a relationship with trade partners abroad. Classically, uncertainty has been shown as one of the key drivers of the volume of trade between the US and China. There's a very interesting study that looked at when China entered the WTO, it didn't actually change the tariff rate that China faced on their exports to the US. Rather, it changed the certainty with which China then knew it would be assured to have those same levels of tariffs when sending goods to the US. And this led to a big increase in trade. There's a famous study showing that. Similarly, you'd see these effects with uncertainty holding back the kind of structural change that Randy and Veronica were talking about. And so I do think for economists, at least, given a lot of the uncertainty is on the underlying disease and is therefore outside of our typical purview, a lot of these dynamics are going to be governed by that.
Certainly true that I see a lot of economists trying to become experts in epidemiology very quickly at the moment. We're getting a lot of questions about the implication of the crisis for commodities markets. Obviously, that's very important to lots of commodities exporters, lots of emerging markets who are facing a crisis right now. One of the defining features or defining stories of the crisis so far has been what's happened to the oil price, which of course in America at least very briefly went negative. Randy, I was wondering if you could talk a little bit about how you see commodities markets right now and what the implications of their performance is for the economic outlook.
You've had this incredible set of storms, not only a big negative shock to demand, but also changes on the supply side. And so oil prices going to unusually low levels, negative. People always criticize central banks for bringing interest rates negative. So now we've seen oil prices actually go negative temporarily. So obviously this is not business as usual, and this means that the oil producers are going to be facing enormous fiscal challenges because they're going to be generating much less revenue than they had, both because demand is lower and because prices are dramatically lower. And so that's going to be an enormous problem in the or challenge in the Middle East. It is a potential opportunity elsewhere as energy prices come down to be able to do more manufacturing onshore that might have been too expensive to do onshore. There are also challenges, however, in thinking about what the implications of that are for the environment and for climate. In the U.S. and a number of other places, many of the new energy producers, whether it's shale oil or others, tended to be very highly levered, have relatively high amounts of debt, relatively low credit ratings, and so are going to get into trouble and have to be restructured. And so it'll be very interesting to see if there's some sort of policy response and saying, okay, we need to restructure this sector. And so if it is to come back, it has to come back more green than it had been before. Because these issues of climate are not going away just because we're having a financial crisis. It'll be very interesting to see how that plays out. But I think with lower demand and for quite some time, less investment because the uncertainty that Brent was talking about, and I think it's policy uncertainty, fundamental uncertainty, and what this world is going to look like, you're going to see commodity prices be low, I think, for quite some time, and that's puts real pressure on emerging markets throughout Africa and the world, and so these countries are going to need to realize that's the new reality, I think, for quite some time.
It also has significant implications for the inflation outlook, I presume. To what extent do you think trends in commodities markets, Veronica, are driving that?
Yeah, so I mean, clearly the drop in oil prices is in another signal that demand shortages are important in this recession. And of course, the natural consequence of that is that prices are going down, and this is exactly what I was talking about before. This is a signal that inflation, there are deflationary pressure coming from the shortages in demand. Now, how about what role this is going to play in the dynamics of future inflation? Of course, as Brent and Randy have mentioned, uncertainty here plays a big role. And the uncertainty that the knowledge of the health characteristics of this virus, I think, is most important, is about the duration of the necessity of public health policy to help the population not to die out. And so I think that's the more challenging question of how long and prolonged this recession is going to be, and this lockdown situation is going to be in different phases and so forth. And again, I believe that at some point we're going to recover, and at that point the oil prices and other commodity prices are going to recover. But as I was mentioning before, so the natural pressure is going to go back up to the original level as long as there are no innovation, as Randy was mentioning, in different sectors that are going to reduce more structurally the demand for oil prices and other commodities. But I think that, again, this is a demand issue, and at some point the recovery is going to happen. We are going to recover, and so when the demand catch up, prices are going to go back up. And again, if not oil prices, other commodity prices that are going to substitute for that, if there is going to be some restructuring in the economy.
It strikes me that emerging markets are vulnerable in the current crisis, as I suppose they would be in any widespread global demand shock, because of the simultaneous problem of their current accounts and being so exposed to commodities prices. And this sort of links to the dollar dominance point you were making earlier, Brent. Do you have any thoughts on the position that emerging markets are in, particularly given the developments in the global financial system you were talking about over the past decade?
Yeah, well, look, all the kinds of policies that, for instance, Randy and Veronica were just talking about take money. This feels more like disaster relief than stimulus, is I think a comparison or a comment, for instance, Paul Krugman made. And typically you want to pay for disaster relief by borrowing a lot. And what's hard coming into this crisis is a lot of countries already had quite a bit of debt. You've seen a record number of countries approach the IMF asking for help, exactly the time when, in principle, governments might want to build up hospital capacity, send checks to people to stay at home. And as I mentioned earlier, in emerging markets, less and less people can stay at home and work. And so the problem is quite large. As I mentioned in earlier work with co-authors Coppola, Maggiore, and Schrager, we showed that the dollar's use in a lot of cross-border borrowing has grown over the last, let's say, decade, which means that these countries now, have a debt load and potentially a larger currency mismatch issue than a lot of times historically. So that does make them potentially vulnerable, if, for instance, their currencies were to depreciate relative to the hard currencies in which they're doing a lot of borrowing. There's been a lot of discussion on how some governments have successfully shifted a larger share of their debt away from foreign currency and toward domestic, but corporate sectors around the world have not had as much success or have not done so as much. And so that vulnerability remains. Relatedly, in our work, we show sort of interestingly that an increasing share of the bonds issued by emerging markets, increasingly when emerging market companies access developed market capital, borrow from Americans and Europeans, they don't do so directly. They do so via offshore affiliates, for instance, located in tax havens like the Cayman Islands or Guernsey as an example. And so another element of this crisis that I think is worth keeping an eye on is once the public health crisis passes, if we are in a period in which corporate debt markets are really stressed and we see a lot of bankruptcies and needs for government to step in and help resolve these things, the financing chains that the world uses these days might look quite different from how they looked in the not so distant past, where now multiple jurisdictions might be involved in any such resolution because you've got investors in one country, the actual bond issuer located in another country, the parent company located in yet another, typically emerging market country. This element of companies either headquartering or issuing through other countries, including tax havens, has become sort of increasingly interesting and potentially important. We've even seen it mentioned in the context of certain stimulus bills. Some countries are discussing the possibility of excluding from the receipt of stimulus certain countries, certain companies that have headquartered in offshore places in tax havens. I think when it comes to the resolution of corporate debts, if we do get to a crisis in that market, this could play out as an important element.
Yeah, I think that's a really big deal going forward, because I think there's going to be an enormous amount of restructuring that's going to need to take place. Many emerging market countries are sort of stressed at their debt levels to begin with, and this is only going to push them further. And then you've got that at the corporate level, both within in emerging markets as well as in Europe, as well as in the US. And so thinking about how to have an expedited bankruptcy system, asset management companies, something where if people decide they don't want to go through what often is a very slow and painful process of renegotiation, go into something like an asset management company with there would be some sort of standardized sets of here's what you get, here's what others get, here's what the next steps are, might be very important to think about. It's difficult for policymakers to think about that now because everyone is still hoping for the V shape to come back. And if you start talking about this, you're talking about a longer term challenge, but I think we've got to start facing that now. In the 1930s in the US, we actually did a very large across the board debt forgiveness. There were these contract clauses that related the value of payments to the value of gold. But in the US, we went off the gold standard devalued by 69%. And so people said, I want $1.69. Ultimately, the government said, no, you can't get that $1.69, you only get $1. That was quite jarring to many. We went to the Supreme Court and it was a very close decision, a 5-4 decision. And the dissenters said that the Constitution is gone, that we're no longer enforcing contracts. But what's interesting is that not only did equity rise in value. You could see that getting rid of the debt overhang and the debt burden. But many bonds, especially bonds of firms that were lower rated and had a lot more debt outstanding, actually went up in value. You might think that that's crazy. How could that be? Because now people were losing the chance to get that 69%. But if that debt burden had gone up by 69%, all those companies would have gone into bankruptcy. The losses would have been even larger, and not only at the individual firm level, but economy wide. And so I think looking at different historical circumstances like this, seeing where it can work. Argentina did something like this back in 2001, 2002. It didn't work very well. So not all debt restructurings and debt forgiveness approaches work. You have to do it very, very carefully. But I think that's something that's got to be on the table, and we need to start thinking about it soon.
We've got just a couple of minutes left, so I'm going to ask a final question, which is, we've had a couple of members of the audience ask what the panel thinks about the recent performance of financial markets. We've got some people asking whether bond markets at the moment are being completely obscured and overwhelmed by central bank bond buying. And then we've got other people asking what to make of what's going on in stock markets globally, where there appears to be something of a division between the stock market performance and the performance of real economies. So I don't know, perhaps Veronica, you might like to take a stab of what we should make of these trends at the moment.
Yeah, so I mean, naturally, there has been the role of central banks as created some tension in the bond market. There is uncertainty about that again. I think, for example, the ECB buying bonds is something that is good, and Germany doesn't think as much, but this is something that I believe we are going to see more and more, and so this is going to affect the bond market. And the stock market is also, I mean, getting a hit out of this recession for obvious reason, and that is less predictable. And so I don't think, I mean, there are financial consequences that are important from this crisis. I think these had to add to what I've said so far about demand. So on top of the real effects of the supply on demand through the income of people, there a lot of demand effect coming from the uncertainty on the financial markets, in the performance of the stock and the bond markets. And so this is going to play an important role in possibly depressing demand even farther down. And so this is the main concern that I think we should be aware of when we think about the policy. The depression of demand and how the financial sector can amplify this effect. And
Brent, any thoughts on that?
I mean, the asset markets have been very volatile. The stock market has gone, moved very volatilely, in a very volatile way at very high frequency. So claiming whether there's a puzzling disconnect or not with current fundamentals, particularly in a context when the stock price is supposed to tell you about the present value of future fundamentals, together, of course, with discounting. But no is the short answer. I think it's very challenging at this point to try and rationalize these very high frequency short run movements. And I certainly would hope policymakers don't think about the stock market as a particularly critical guiding light to things that they're thinking about to remedy the real performance of the economy.
Randy, anything to add on that one?
Sure. I think, on that volatility point, I think it shows how the markets are struggling, that it underscores the uncertainty point, because every new bit of data that comes out about a potential cure or a new outbreak, the markets move enormously. And I think it just shows that there's a lot of uncertainty, so they're reacting very strongly to very small bits of information because it's such an uncertain environment. And in that uncertain environment, it's going to be really difficult for firms to feel comfortable to do investment, as we were talking about before. And I just worry that people think that certain policies, like that the Fed, that the Fed has the power to kind of cure the virus, and I think we saw that in February when the data were coming out, and there were some movements in the market. Market went down, but then it kind of came back up. We said, oh, well, the Fed can take care of it, or central banks can take care of this. The ECB will take care of it. The Bank of England will take care of it. That's then I think the realization came that's probably not going to happen. Then there were a lot of fiscal responses that I think have helped to give some comfort that there'll be some support for business and enterprise going forward. But I think we're going to see enormous amounts of volatility. I think it's very difficult for the markets to figure what's going on. It's difficult for policymakers to figure out what's going on. And so I think true also on the fixed income side of things, because there've been so many interventions by central banks, and they're purposefully trying to prevent various sectors from collapsing. They're purposely trying to make things easier, to bring some of the risk spreads down. That may make it more difficult for some of the signals to be sent to the market, but the alternative, which is markets crater, risk spreads explode, that could lead to make it much more difficult to have recovery. So central banks are trying to put the foam on the runways as the economy is sort of coming down. I'm hopeful that will have the right impact of easing things rather than making things more difficult. But it is also making it more difficult for people to see what the appropriate signals are in the markets.
Well, I think we all share that hope. That's all we've got time for today, I'm afraid. So all that's left for me to do is to thank Chicago Booth for putting on this great session, to thank our panelists for an excellent discussion, which I, for one, have enjoyed a lot, and to thank you all for joining us, and wish you a good rest of your day. Goodbye.
Bye.